Welcome to The Explainer. Today, we are talking about the two rulebooks that basically dictate financial reality for companies all over the world. And here's the crazy part. Depending on which rulebook a company uses, the story it tells can change completely.
So, here's what we're going to get into. We'll look at how one single business can tell two totally different stories. We'll ask, how much is all its stuff actually worth? Then we'll see what happens when things get really complicated, like in a merger. We'll see how all that affects the final numbers, and most importantly, why you should care about any of this. All right, let's kick things off with a bit of a paradox, shall we? How can one business tell two completely different but totally valid financial stories?
Now that's not some kind of philosophical riddle. It's the reality for thousands of global companies, every single day. And the answer? Well, it all comes down to the accounting language they speak. And just like any language, these have their own grammar, their own vocabulary, and even their own unique philosophies.
Okay, so on one side, you've got US GAAP, which is set by the Financial Accounting Standards Board, or FASB. On the other, you've got IFRS, coming from the International Accounting Standards Board, the IASB, which is used pretty much everywhere else. And the key difference is philosophical. Think of it this way. GAAP is like a super detailed recipe, very specific instructions, very precise measurements. IFRS is more like a general cooking method. It trusts the chef, the accountant, to use their professional judgment to get the best result.
So, where do these two languages really start to argue? Well, one of the biggest points of conflict is how they answer a really basic question. How much is a company's stuff actually worth?
Let's talk about inventory. In a world where prices are always going up, US GAAP lets a company use something called the LIFO method. That's last in, first out. It basically means a company gets to say that the newest, most expensive inventory it bought is the first stuff it sold. And what does that do? It leads to lower reported profits and, you guessed it, often a smaller tax bill. IFRS, on the other hand, says, no way, it's completely banned.
Now, the difference gets even more stark when you look at big physical assets like buildings or land. Under GAAP, if a company buys an office building, its value on the books is pretty much locked in at what they paid for it. But under IFRS, if that same building is now in a hot real estate market, the company can actually revalue it to its new, higher price. I mean, we're talking about potentially adding millions to the balance sheet, practically overnight.
And this flexibility goes both ways, for downturns too. So let's say a company writes down the value of an asset because the market crashed. Well, if that market recovers, IFRS lets the company reverse that write-down and bring the value back up. But under GAAP, that loss is permanent. It's a one-way street, no take-backs.
So you're probably starting to see the pattern emerge, right? US GAAP really favors these strict, rigid, prescriptive rules. It's all about consistency. IFRS, on the other hand, offers a lot more flexibility, and it relies on professional judgment to paint what it sees as a truer economic picture.
Okay, so what happens when we take these clashing philosophies and throw them into the high-stakes world of mergers and acquisitions? That's where things get really interesting.
So when one company buys another, we call that a business combination. Now, on the surface, both systems seem to agree. They both use what's called the acquisition method, but that's pretty much where the agreement stops.
The devil is really in the details, and they get complicated fast. Like under GAAP, you have to do this mandatory test just to figure out if you bought a business or just a pile of assets. Under IFRS, that test is optional. Or think about the piece of the company you didn't buy, the non-controlling interest. IFRS actually gives you a choice in how you value it. GAAP doesn't. And look, these aren't just little accounting quirks. They can fundamentally change how a huge multi-billion-dollar deal looks on paper.
It is the exact same story when you're checking to see if an asset has lost value, if it's been impaired. IFRS gets straight to the point with a one-step test, but US GAAP, it adds this extra screening step at the very beginning. And this little difference is actually huge because that first step makes it much harder to actually recognize a loss. It can sometimes let a company avoid writing down an asset even if its market value has clearly tanked.
So all of these different rules eventually have to come together and shape the final numbers we see on a company's financial statements. Let's look at how that actually plays out with things like potential lawsuits or big pension obligations.
So, picture this. A company is facing a big lawsuit. When does it actually have to book that potential loss? Well, both systems use the word probable. but their definitions are worlds apart. Under U.S. GAAP, probable means it's really likely to happen. Think 75% or higher. Under IFRS, it just means more likely than not, anything over 50%. That much lower bar means IFRS companies often have to fess up to bad news a lot sooner.
And what happens if you know you're going to lose money, but you're not sure exactly how much? Let's say it's a range. Well, U.S. GAAP says, be conservative, book the lowest possible amount. IFRS, on the other hand, says, split the difference, take the midpoint. You can see how you get two totally different outcomes from the exact same set of facts.
So the bottom line here is that the same exact event, like a major corporate restructuring, can look wildly different depending on the rulebook. And as the source material puts it, and this is a great way to say it, these differences in thresholds and measurement often lead to liabilities being recognized earlier and at different amounts under IFRS.
This split personality even applies to pensions. Let's say a company's pension fund has a surprisingly good year, or a surprisingly bad one. U.S. GAAP lets companies kind of smooth out that shock over a long period of time. IFRS is way stricter. It says that gain or loss has to be recognized immediately in a separate bucket called Other Comprehensive Income, or OCI. And, this is the key, it's never allowed to be recycled back into the main earnings number. So you get a more volatile, but maybe a more honest picture of what's going on.
Okay, so we've been deep in the technical weeds here, I know. You might be asking yourself, why on earth does any of this actually matter in the real world? Well, it matters a lot.
Because this isn't just some academic debate. For an investor, these rules can totally change all the key financial ratios you rely on. For companies trying to merge, it can change the entire price and logic of a deal. And for big global corporations, they live this every single day. They have to be bilingual, speaking both languages to manage their books. The simple truth is, you just can't compare a company from Germany to a company from the US without first understanding which language they're speaking.
And you should know, these rules aren't carved in stone. The people who make them are constantly updating them, trying to keep up with new economic realities. I mean, just look at the brand new guidance from the FASB on how companies should account for crypto assets. These are living, breathing documents.
So, after all that, what is the one thing you really need to take away from this? It's that before you analyze a company's performance, before you calculate a single ratio, before you even think about making an investment, you have to ask one simple but absolutely critical question. What language are these numbers written in? Is it GAAP or is it IFRS? Because as we've just seen, that one answer can change absolutely everything.